for those who could not watch or the audio and video was spotty, this is Module 9, and I'm going to talk about weighted average cost of capital. So the weighted average cost of capital is a result of the fact that no one knows quite what discount rate to use. There are all these different methodologies that one could use, and they give us discount rates for debt or for equity, and we don't really know how to combine those. And so the weighted average cost of capital is a way of sort of incorporating all of these different measurements into one number. So we can use the cost of equity to calculate the value of the equity, but we need to calculate the entire enterprise. And therefore, we're going to use the weighted average cost of capital. And the weighted average cost of capital only works if there's not like huge changes in the market in terms of risk and the cost of capital. So an example of how this would break apart would be the recent pandemic. The market's been up and down. I don't know if you guys noticed, but yesterday the market went up 10%, or I think 11%. It was the largest one-day increase since the Great Depression, since 1933. And so therefore, WACC would be really difficult to use right now because the value of a company's debt and the value of their stock is constantly in flux. Interest rates are changing. We're trying to figure out what to do with all of this new stuff going on in the economy, and so weighted average cost of capital would not tell you a whole lot on this particular day. Here's the formula. I think this, in my opinion, is the easiest formula, but there's other ways of expressing it. So the formula is percent debt times the post-tax cost of debt plus the percent equity times the cost of equity. The only reason we have post-tax here is that debt has a tax benefit, and so if you have a mortgage, you get a discount on your taxes as a result of having that mortgage, and companies do too. So taxes their taxes are cheaper as a result of having a larger percent of their financing being in debt. And so there's all this question about like discount rates. Should the discount rate be, let's say I want to buy a company. Should it be the discount rate for my company? Should it be the discount rate that company uses? What discount rate should we use? And they have a high estimation error. So, which one should we use? There's a bunch of different methods. They all come up with a different method. This is what we're going to talk about today is one potential method. And let me just give you an example of discount rates in general. So my sister works for a shipping company, and the shipping company wants to figure out if they should work on a particular project or not. And what they do is they say, okay, well, what should we discount it at? And the CEO has told them he wants everything discounted at 15%, no matter what. So if it doesn't have a positive NPV at 15%, he doesn't care. And he doesn't want to look at the project. So it doesn't matter what the risk is. He doesn't really think about risk. He only thinks about the discount rate being 15%. That is not the proper way to do it, but the guy's in charge of the company, and so that's the way they do it. And it depends on what company you work for as to whether or not they make decisions that are reasonable given the discount rates and what should be happening, or what should be incorporated into those. Another example would be when I was in senior housing, the discount rate for senior housing or for seniors who are interested in moving into senior housing and want to figure out if they should invest in these communities is, uncertain. Should they invest? Should they say that they require a 7% return because that's what the S&P has done all these years? I don't know. They're not invested in stocks. Should they ask for the risk-free rate because that's their opportunity cost? If they weren't investing in this project, they would only get the discount rate. Should they ask for lower than that? Should it be zero because they're spending down their money and they care a lot about current consumption or future consumption? No one knows. And there's a lot of debate back and forth about this. So just know that discount rates are really, really hard to calculate. And it is weighted average cost of capital is one way of potentially calculating them. And so this is kind of what I've already said, but each project can have their own discount rate depending on the risks. You might, an example of this would be, if you were a company, investing in a potential factory might be a low discount rate because it's a low risk project, but investing in a third world country and creating a factory there might be a much higher discount rate because the risk is higher. And you can use it to calculate weighted average cost of capital to calculate enterprise value. And usually you use the free cash flow from that project to calculate it. You can also use the dividend discount model or CAPM for the cost of equity. Here is his equation, Professor Hall. His has more terms. So the cost of equity is kind of what we talked about earlier. It's going to be a percent. And then the value of equity divided by the value of equity plus the value of debt, that's going to be a number. So for instance, if I'm Walmart, the value, I don't know the numbers on this, so don't quote me, but the value of equity might be $1 billion and the value of debt might be $2 billion. And so therefore we put a 1 here and the value of debt would be 2 plus 1, so it would be 1/3. And then we do cost of debt times 1 minus the corporate tax rate times the percent of debt that's in the company. So for instance, these two should always add up to 1 because the value of equity and the value of debt makes 100% of the financing in the company. And the last thing that's really important about just inputs is that you want to use the market value. So this is the market value of equity, and the book value of equity is going to be completely different. It's an accounting number. Do not pay attention to that. Just look at the market value. You can, and I kind of mentioned this, you can also use project discount rates, so the cash flows, and that would give you the value of the company. So for instance, if you had $10 in cash flows for the next 1,000 years, you would use that and discount it at the weighted average cost of capital given their current debt and equity portfolio. You can use CAPM to calculate the cost of equity. And again, we talked about it last week. CAPM is not perfect. There are all kinds of problems with it. And you can use other methods if you want. It's up to you, but just recall that it's not always perfect. The cost of debt is usually like some current yield on your bonds. So if you think about what people would be willing to pay for a company's bond today, that's probably their cost of debt if they were to get more in the future. Corporate tax rate is usually 20 to 25%. Depends on your assumptions. The last part of the slide, this part uses CAPM, so it says if the risk-free rate is such and such and the market premium is this, given the beta of the company, the cost of equity is approximately 13%. And then we look at the cost of debt and we say that the yield to maturity is going to be 3.63%, and we're going to use that. If a corporate tax rate is that, and the median leverage in the industry is 18%, well, the weighted average cost of capital, given those assumptions, is about 11.2%. So the point here is that you can use information from a lot of different sources in order to figure out what the weighted average cost of capital is.